All right, so thank you guys for coming and welcome to the Financial Literacy Workshop Series hosted by the Cupertino Youth Activity Board. I'm Kelly.
And I'm Rachel.
And we're going to be your MCs this afternoon.
For our first session, we have an amazing panelist from the KeyPoint Credit Union who will be talking about the basics of money management. He'll be focusing on the different types of financial institutions and the products, services, and tools they provide to help you manage your money. He'll also be covering financial terms that teens may be unfamiliar with.
As a reminder, feel free to leave any questions you may have during the presentation in the Q&A chat. Our YAB members will be facilitating the chat. At the end of each presentation, there will be a 10-minute Q&A session for any questions you may have. Now we will begin with the Ron Neumann.
Well, thank you very much, Rachel and Kelly, for introducing me, and thank you very much to the City of Cupertino and the Youth Activity Board for allowing us to present financial literacy for youth teens at the City of Cupertino. I'm going to share my screen. Just make sure that. Can you see my screen?
Yes, we can see it.
Okay, well, wonderful. Yeah, so my name is Doron Neumann. I'm from KeyPoint Credit Union. I'm the Vice President of Sales and Development. I work for Credit Union for the last, KeyPoint Credit Union for the last 16 years and been in the banking industry over 25 years. So I do this, I did this many times, and I enjoy much doing financial literacy for teen, adult, and really helping people improve their financial health. This series is a three-part series that we start today with basic of money management. We're going over a little bit about what a financial institution are, what the product we provide, services, and the tools that will help you to manage your money. The next session is in November. We talk about really understand credit, what is credit score, and why it's important, and how to build credit and how to maintain credit. And then once we did finish these two sessions, the third session is going to be on January 24th. And we put everything together to really learn how to manage your money, make good decisions, and put a budget together and set goals and build a strong foundation for your future financial health. So there are a lot of questions when people talk about financial literacy. There's a lot of terminology. There's a lot of people sometimes afraid because they'll talk about money. And so what we do with money, where we taking it, how we make more money, and so forth, and who help us to manage our money. So if you look at the years ago, or maybe some people do it right now, is they digging a hole in the backyard and hiding their money or putting in the mattress. And so we needed solution many years ago to do what you can do with the money. How do we actually help do transactions, help to keep the money safe, and so forth. So many years ago, financial institutions were formed. And financial institutions is really as an organization, like a credit union, a bank, a brokerage, that's licensed to take deposit, to handle your money, take deposit, make loan, and offer financial services such as deposit account, checking account, loans, investment services. Most country financial institutions are regulated by the government and usually by the central bank of that country. Financial institutions are important to the economy because they provide a vital service for both consumer and businesses. With no financial institution, the economy really going to have a hard time flourish, because in order to make transactions, in order for you to pay someone for goods and services, you need some system that will help you to do it more efficient. And this is why financial institutions are come into play. And also, if you need to get some loans, you need to buy a home or you need to buy equipment for your business, you need to get it from somewhere. And this is where financial institutions are come to play. So really, financial institutions are companies, that organization where you deposit your money in the financial institution. What they do is they take your money and lend it to others. So this is in general what financial institutions are. There's a number of financial institutions. There are credit unions. There are banks. Credit union, if you drive around, you see credit unions like, KeyPoint Credit Union, there are Mary West, there's TextEU, there are many other credit unions. Banks, you see Wells Fargo, Chase, and other credit union. commercial banks, banks that only focus on businesses. So if you're a business, you usually go to this bank because they specialize in helping businesses. Banks like Comerica and Heritage Bank, mutual banks, there's savings and loans, investment banks, there's some investment banks, private banks who really handle people that have a lot of money. Usually private banks deal with people that have in excess of a couple of $1 million, and they really provide very specialized services to those people. And then online banks, there are banks that actually are specially just online and they don't have any presence as branches and so forth. This is some of the financial institutions that you may be familiar with. And then central banks. The central bank, you heard about the Federal Reserve, or many countries do have the European Central Bank, in England, in France. So those are banks that are regulated and help other banks with the flow of money and so forth, and with regulation to make sure that consumers are protected. So a little bit about difference between credit unions and bank. I'm not going to go too much into details, but the difference between credit unions and banks, and most people in a credit union, you have to be part of certain group to join. So you have teachers credit union, where you have only people that are teacher can join that credit union. People that work in the technology industry, they can join credit union. So they form organization almost like it's association where it's a non-for-profit, and the members, customers are called members. And what happened, the board is elected, the board, the governor, the credit union elected from the membership for the customers. With banks, anyone can join. Anyone can go in the bank and join. You don't have to be part of any organization. It's for-profit organization, and the board of the directors is paid board of directors, and profit are distributed to shareholders. The shareholders, usually they trade in the stock exchange, and the shareholders get the profits in terms of dividends and growth of stock. We all pay taxes. Federal banks pay federal taxes. Credit union, most of them are exempt, but they do pay taxes. And both institutions are regulated by the government. Banks are regulated by the FDIC, and we're going to go a little bit more into it. And credit union are regulated by the CUNA, the National Credit Union Administration. This is a little bit different, what the difference between banks and credit unions. So we're going to go a little bit of terms, and I like to go in terms, talk about certain terminology, because sometimes when you hear words that you don't know, it can be scary. So people avoid the subject because they hear terms. One of the great things that I learned, and I had a great professor in college that told me when I started, he told me always read the terms, the terminology for the subject. Usually you have a textbook, you read the terms in the end of the book, you learn about them. So when you come to the subject, you really understand some of the terms, and it makes it much easier. So I'm going to go a little bit about terms. So deposit or loan accounts. What are deposit and loan accounts? So deposit loan account is a financial institution account that maintained by the financial institution, with the financial institution transaction between you and the financial institution. So if you have an account, any account that you hear, it's really a transaction between you and the financial institution. So there's a shell to say, I can deposit money and I can take money from this account. This is what account deposit or a loan account. Account holder. When you have an account, you're the designated authorized to transact business on behalf of the account. So no one else, and if this is your account, you're called primary on the account, and you have a signature owner of the account, meaning that you're the only one that can transact to this account. So if someone comes to the financial institution and take your information and try to do transaction in your account, they cannot, because you're the one that actually only one that authorized on this account. Sometimes, and especially when you're a teenager, you're going to have a joint account, meaning that you have a adult that is, because you're still minor, you're going to have someone that actually join on your account. And later, maybe you're going to have a spouse or a significant other that will be joined on your account, and mean that the other person can do transactions on the account. So you can have an account where you're the only one, and you have the same account that you have a joint person on the account and can do transaction. But anyone that register on the account and has the authorized signature on the account can do transaction on the account. So what kind of accounts do we have? There are different type of accounts in the financial institutions. So the first one most of you heard about is checking account. We do have savings account, money market accounts, certificates, and we do other accounts like individual retirement accounts and different account that we have, but health saving account. But I'm going to focus right now on these 4 accounts and go over them a little bit in more details and explain what are the accounts and what can you do with these type of accounts. Also, we're going to talk about, beside accounts that where you deposit, you put money in, the different loans that financial institutions provide. So home loans, mortgage, a home loan called mortgage. You have a mortgage account, you have a car loan that the financial institution can provide, student loans, personal loans, credit cards are loans, business loans. So those are the type of loan accounts that financial institution can provide. Of course, there's many other loans, but those are the main loans. I mean, you could have, if you want to buy a boat, you could have a loan for a boat. You can have a loan for a motorcycle, for RV. And so there are different other types of loans, but those are the main loans that financial institutions provide. So we're going to deposit. So what is deposit? Deposit is money that transfer put into an account. When you go into your account and you put money into, it's called a deposit. You deposit money into your account. And when you do transfer online, someone put money into your account. Every time money goes into your account, it's called a deposit. So, and the next one is taking money out of the account. So some people have a piggy bank and they take a hammer and they break the piggy bank and they get their money. But if you have a bank account and you have a checking account in a bank, it's called a withdrawal. So anytime that money is leaving your account, so if you take money out to the ATM, you go into the branch, take money, or you go online and transfer money from your account, you withdraw money from that account. So anytime that money goes from any type of account, it's called a withdrawal. And what is checking account? So checking account is really an account that helps you to manage your income and expenses and pay your bill. It's really on a daily account that you can manage your daily expenses and help you to manage your money. So you can see exactly, I mean, what's coming in, you know, how much money you're coming in. So you have income or wages and you come in, and this is the money deposited in your account. And then you pay your bills, or you take money, when you pay with your debit card, or you transfer, you buy something over Amazon or Starbucks. Actually, you can see there's a ledger and you can see what expenses coming out of your account. Means which will help you to manage how much money you have. And we'll go over it a little bit more detail in a few minutes, but really a checking account is an account that helps you to manage the day-to-day money, income and expenses and pay your bills. So also beside this, we want to make sure that when we have money, we want to grow your money and then make sure that we have getting a little bit more money out of it. So what we do, we have type of savings account. So what is a savings account? A saving account, an account that lets you store money securely and earn interest. And we're going to go over interest in a few seconds. So financial institutions pay you interest to keep your funds deposited in their account. Usually regular savings account are account where you want to keep your money for any emergency. So if you have any type of emergency or you have a long-term goal, this is where you want to keep your money. So usually when you start making, you have a job and you start earning money, the recommendation that you will keep in your saving account at least 6 months of expenses. So let's say I make $1,000 a month, and this will cost me to leave my expenses to be $1,000. I will save $6,000 in my saving account to make sure that I can at least survive for at least 6 months with what I have in savings account. So it's a money that you want to keep aside and not spend it on things that you don't really need. And those are usually money that goes to emergencies or anything that unexpected that's coming up. So this is a savings account. You put it, and the bank pay you, or the financial institution pays you interest on it. So every time you besides, there's some checking account that pay you interest, but most of it on the saving account, you get pay interest. When you give the bank, the credit union, your money, and they will pay you for it. You pay your fee. The fee is the interest. Money market. Money market is a type of savings account. It's different than savings account. And actually, you can have you get paid higher interest on your funds. So you put a little bit more money in your money market account, and usually it's about either start at 1,000, 2,500. Some institutions start at 10,000, but you earn much higher interest than you earn on your savings account. The thing about savings account as well as money market account, it's allow limited withdrawal. So really, you're limited to sometimes 3 to 6 times per month that you can actually withdraw money. On savings account, you do not have checks. On money market account, you can write a check against your funds, but savings account do not have checks, and you can write the checks. There's a government regulation that says that if you withdraw more than 6 times out of your savings account, you have to pay penalty. Just the government want to make sure that we encourage people to save and have money in case of emergency. So if you put money in your savings account and you take it more than 6 times, you will incur some fee. So money market is account where it's a savings account where you have a little bit more paid higher interest than a regular savings account. There are also sometimes that the high balance savings account and different kind of savings account that pay a little bit higher than the regular savings account. What is certificate? Some people call it certificate of deposit or certificate. So certificate is similar to savings account, except the fact that when you put money in certificate, you actually the money you cannot withdraw it for a certain amount of time. You can earn higher interest than you earn in a money market or a savings account, but your money is locked for a certain period of time. So sometimes there are different terms. It's 1 month certificate, or 2 months, 3 months, 4 months, 6 months, 12 months, 24 months. Usually the longest is 5-year certificate of deposit, mean that you give the bank, let's say I give $1,000, and the financial institution will pay me a certain amount of interest. It's higher than the savings, but I'm not allowed to withdraw this money. In case that I do need to withdraw, this money, usually there's a high penalty on this fund. So it's a contract in a way. A certificate of deposit is a contract between you and the financial institution. Say, I will put this amount of money in my financial institution. I will lock it for certain time, let's say for a year. And if I take the money out of it, I will pay penalty. But in turn, the bank or the financial institution, the credit union will give you higher interest. So this is certificate of deposit. Usually people put money in certificate of deposit when they know that, oh, I have extra money and I do not want to spend it right now, and I maybe spend it for a year and I want to earn a little bit more higher interest. I'll put it in certificate of deposit. Next one is your money insured. So we talk about the fact that before people were hiding it in the mattress, digging a hole in the backyard and hiding the money. And what happened if someone water your backyard and your money is just getting wet and gone, and you can use it. So what happened with financial institutions? Is your money insured? And yes, your money is insured. For the government insures your money and in a financial institution. So the banks are insured by the Federal Deposit Insurance Corporation. You may hear about it. It's called the FDIC, and it's a federal. They insure all federal and state banks. While the National Credit Union Administration has a division called the National Credit Union Share Insurance Fund, in which insure all credit unions. Usually a deposit account insure up to $250,000 per person that sign on the account. And so what happened is, let's say that you have in your account $2,000 and the financial institution is going out of business, you will get this fund back as the government will insure it. So you will receive the $2,000 back when this financial institution is going out of business. So it's the fund insurance. What happened if let's say you have one account, and this get a little bit more complicated. I just want you to know the concept that your deposit accounts are insured up to 250,000. If you have one person on the account, it's 250,000. If you have two people on the account, it's now became $500,000 that the account is insured. Doesn't mean that if the bank goes out of business, you get $500,000. Mean that whatever the money that you have there, you will get that money. But if let's say if you have $300,000 in this account, and the bank's or the credit union goes out of business, you only get 250,000 on that account. So the maximum per signer on an account is 250,000. But really, the main idea I want you to know that when you put your money in the financial institutions, you want to make sure that ask if you're going to open an account, is my account is insured by the federal government, by FDIC, or by the National Credit Union Administration. And it's important to know that you can feel comfortable to put money in the bank. This is why they did it, so people feel comfortable to deposit money in the financial institution and not put it in the backyard. Next, I'm going to talk about a little bit about some terms, banking terms. So we talk about interest, talk about ATM and PIN number, account number and routing number, debit card, online and mobile banking, fees, and disclosure. So we start with interest. So interest is really a fee paid on borrowed money. When money is in deposit in interest-bearing bank account, the interest or the fees paid to you for as you deposit the money in the bank or in the credit union. So it's a fee. So the financial institution pay you a fee to deposit the money, your money, into their financial institution. Usually different financial institutions compete where they pay a little bit more higher interest. They try to persuade you to put money into their financial institution. Interest is also, most people talk about how much you pay interest. When you borrow money from the financial institution, you pay the financial institution back interest on your loan. So when you deposit, the financial institution pays you interest. When you borrow money from the financial institution, you pay back interest. So really, interest is the fee that is paid on borrowed money. And some people a little bit confused, some get confused about it, but it's very simple. When you put money into your financial institution, they will pay you interest. When you take money from your financial institution in terms of a loan, you will have to pay back some interest or the fee to use the money. So it's the fee for using money is interest. I'm not going to go much into interest calculation right now. There's different type of interest rate that you pay. There is a compound interest, there's simple interest. Compound interest is interest on interest, where simple interest is just interest that we calculate on the principle of how much you have there. And we will go over it a little bit more in details in the next 2 weeks, but this is just really in general what is interest and how financial institutions using interest and what does it mean to you. Saving account, again, the financial institution pay you interest for using the funds. In this case, you're the depositor, and the loan, you pay the financial institution interest for using their fund in case you're the borrower. So when you deposit, you're the depositor. When you take money, you're the borrower. So ATMs and fee. So ATM stand for automated teller machine. So if you're familiar with the branches and you went to a branch before, you know that you go to a financial service representative with a teller and you can do a transaction. You ask him, I want to withdraw $10, $20, $30 from my account. And they will get you to sign something and they give you your money. In the 70s or so, 70s, 80s, ATM started coming up, and actually with it was make it easier for you because you can go anywhere to withdraw money. Where there's ever ATM, you can actually go and withdraw money. Before, you could only go into your branch or your bank and a credit union and withdraw money before the ATMs. You couldn't take it anywhere else. And here suddenly comes the ATM and make things easier because now you can withdraw money from anywhere. So ATM is actually able to do most of the transactions that you can do within your branch. You can do withdraw money, you can transfer money, you can deposit checks, you can deposit cash, you can get your inquiry, how much, what is your balance. You can transfer money between accounts. So you can do a lot of things on the ATM. And a nice thing about ATM, it's 24/7. You can go to ATM anytime, any day, anytime, and do transaction, regardless if your branch is open or closed. So it's really a convenient matter of convenience that you can actually do transaction on ATM. ATMs, use of ATM, some institutions do take fees on the ATM, means that you, when you go, let's say you have an account with a credit union and you take money out of the credit union from their ATM, you will not incur any fee. However, if you go and let's say you travel and you go to someplace else and you have see an ATM from a different financial institution, from let's say from a bank someplace, and you put your debit card in and you take money, you will incur a fee. So you're going to have a fee that from your financial institution as well as from the financial institution that own the ATM. So, but there are different programs for different financial institutions, but usually there's certain fee that associate with taking money out of an ATM, and something that you want to check when you go and open your account in any financial institution. What are the fees? And we're going to go into it in a few minutes. PIN number. So everyone has when you have when you use your take money from the ATM, you have to have a debit card, and you have a PIN number. So personal identification number. Everyone is a security measure to give to the account owner access to their fund to the ATM. So unless you have a debit card and you can put your PIN number, you cannot withdraw any money. Today, with the new technology today, actually you can do it with your cell phone, and some ATMs going to start using some biometrics. But most of the times, even use biometrics or use your cell phone, you still have to put a PIN number. So a PIN number is a secret number that you put. Sometimes it's 4 digits, sometimes it's 6 digit, and this is only your number. No one else knows. So you set it up, and when you can use it on ATM. Never, never, ever share your PIN number with anyone, because what happens if you share your PIN number and someone go and take your debit card and take money out of the ATM, it's your responsibility. So you lose this money. So never, never share your password, your PIN number, and so forth. We're going to go with it in a few minutes. And it's your personal identification number, and you want to make sure that you keep it a secret. And this will enable you to use the ATM and withdraw fund from the ATM. As you see, ATM, you can actually deposit money into the ATM and then withdraw money into the ATM. And it's really nice because before it used to be the ATM, we just dispense $20 bills. Today, ATM is able to dispense $20, $10, $5, $100, $50. So they're actually different different amounts of money that the ATM can dispense. ATMs also do have daily limits, so just as a measure of protection. So some institutions say, well, you can withdraw only $600 or $300, and just to make sure that if someone steals your card, they cannot empty your checking account. And so usually there's some limit on how much money you can withdraw out of ATM. Account numbers and routing numbers. So this is a check. Less and less people are using checks, but checking account called because you get a checkbook when you have opened a checking account. And this is a check. A check is a piece of paper that you can write to someone, and this is instructions. What it really means is an instruction to pay someone a certain amount of money. So what is the account number? Every account has a different account number. You see there, the account number for this check is 67243010068. It's a unique number for your account and the institution. Every account is a unique number. They know that this is your account. Also, there's a routing number. Each bank, financial institution has a routing number, so they know that actually your account reside within this bank, with this branch, and this is where your account. So when you pay someone, the money goes out of this account. So each bank or credit union or any financial institution has the identifying number that tell them what is where's the branch and what bank it is. So it's called routing number. And then, of course, there's a check number, and you write the checks. It starts with 1, 2, 3, and then go up on the check numbers. Usually, when you open account, sometimes you get what's called a starter check, meaning that it's printed within the branch, but it doesn't have it's just a starter check. And usually, you get number depend on the institution. They assign what number they assigned for you, and then usually later you will get your checkbook with your name on it and everything on the checkbook. So check, when you write someone a check, it's really when you deposit in the bank or the credit union, it's identifying, say, please pay this person this amount for my account. Debit card. So debit card is really a piece of plastic that help you to take money out of your account. It's actually, a debit card is almost a electronic check, and it's identified, it's assigned to you, and has assigned a PIN number to it. So you can actually do many transactions with a debit card. Before, you had to go into the branch, take cash, and go around and pay, pay your grocery or pay any other place that you go do purchase. Today, you don't have to carry money with you because you can have a debit card. You can take, with the debit card, you can take money out of your ATM. You can pay in a store. So the debit card is a mean of payment that actually link to your account. Now, when you have a debit card, if some of you do have a debit card, I wanted to just go over a little bit of what debit card is and what are the things that debit cards, so you know. So really, in the top, and number one is, you see on the top card, and the front of the card is your bank or credit union name, the card number. To identify you, each card has a unique number, and this is the way that you identify that this unique number is linked to your account. There's a cardholder name, I mean, your name going to be there. There's a payment network. So the payment network, you heard about Visa, MasterCard, American Express, the different payment networks. So their logo going to be usually on that place. And some places don't take all payment networks. So you need to make sure when you go into ATM to make sure that your the ATM does take your payment network and you can use it. Expiration day. So there's expiration day on your debit card, and then number 4, if you see, it's a smart chip. Actually, there's a smart chip now. Most of debit cards do have smart chip on them, and the smart chip actually contain your information, encrypted information. So it help protect your card from being breached or being taken. The information is taken from it. If you look at the back, you have number 1 is the magnetic strip, and actually when you swipe it and you go to the store and you swipe your card, it actually has the information in it. Now what happened, and the information in the back has to match the information on the smart chip in the front. If it doesn't match, it doesn't, the card won't go. So it's all encrypted information. But what it tells you that the bank, when you swipe it read the information and say, this person, Jane, just went to the bank, to the store. She bought $50 worth of food and paid the store $50. And when you swipe it, it's run very quickly over the network, and it takes money out of your account and move it into the grocery store account. So also in the back, you see hologram. It's another security feature. And then under it is the bank contact information and the network logo. And then number 5 is a security code that you have there, and it's identified. Each card has a different security code. And usually if you do any transaction online, they will ask you to put a security code. This what it mean. You're going to see a 3-digit security code that you will have to put, and if it's not, mean that the card will not work, because it's all has a lot of security measures on the cards, and need to make sure that all match together in order for the card to work. And then number 4, it's signature. Every time you get a debit card, you want to sign it. You want to sign the back of it with your name. In actuality, most retailers are required to look at the signature card, but many people don't do it. But I want to make sure, just to protect yourself, you have a signature, and just to make sure that they know that this is your car. Sometimes they will compare it between your driver license and your card to make sure that you're the person. So there are a lot of security measures on this card, but it's a great thing to have, so you can actually take money out of your account in any place and make it more convenient. Today we also have online banking. So instead of just going to your branch, you can actually, on your ATM, you can actually do transaction online to your desktop, or to go into your browser, and you can do it. You can transfer money. You can see your transactions. You can see what account you have. You can open an account. You can apply for a loan. You can do everything on your online banking. So you can conduct many transactions and manage your account from your computer, so you don't have to actually go to the branch. And the whole time you used to go out to the branch and see your information. Today you can get all your statement online and everything, and you can check your account on a daily basis to see how much money you have and so forth. And mobile banking, and now with the expansion of mobile banking explosion of mobile banking that happened in the last, I will say, 10 to 15 years, everyone is transitioning to mobile banking. So actually everything you can do on the desktop, you can do on your mobile device. You can look at your credit, you can look at your balances, you can transfer money, you can make a payment, you can do bill pay, you can actually pay your friend if you need to pay them, you just pay another person. So you can do many things on your mobile device. And every time you open an account, I will encourage you to read what are the functionalities and what are the things that you can do on your mobile banking. Account disclosure. So accounts, really any account, if it's a deposit account, a checking account, savings account, or any loan, it's a contract between you and the financial institution. It's a legal contract that says that they will, if you deposit money in a credit union bank, they say that they will handle your money, and they will have to give you your money at any time. It has to be available for you to withdraw. So this is a contract. On the other hand, let's say if you borrow money from the credit union or the bank, there's a contract that says that you will have, and we just gave you our money, and you will have to pay it back. So anything you do with the credit union or the bank or any financial institution, always treat it as a contract, because you do sign it, and there are a lot of different rules and regulations and different conditions. So you need to make sure that you always read it and make sure it's called disclosure. Disclosure is where all the document that contain the important information and rules and fees about your account. And fees. So, you're going to hear about free accounts. Yeah, there's some free accounts. There's some, different kind of fees that financial institutions have to make some money to stay in business. So there are different fees that happen. So the maintenance fee on the account, and what happened when you're part of the disclosure, part of the document, you will have a fee schedule. So always want to make sure that you ask for a fee schedule to see what fees might be on your account. Usually for teenagers and students, most financial institutions provide free account, so you can actually, it doesn't cost you anything. There's no minimum balance. So sometimes the checking account fee, minimum balance charges. So if you don't have certain minimum balance, you will be charged on a monthly basis. As I say, most of you want to ask, most of the accounts that come for student accounts, most institutions today do provide free account or minimum balance, meaning you don't have to have a high balance to maintain the account. Overdraft charge. Overdraft means that if you overdraw your account, let's say you have a $50 in your account, and you went to do a purchase, or you wrote a check, and the check you wrote $100, now you're negative $50, you will have a fee. and so you will have an overdraft fee on your account that you took more money from that you have in the account. One thing I want to go back into the ATM for a second and mention that in the ATM, the debit card is that it's tied to your account, so you cannot take out more money that you have in the account. When it means that if you have only $100 in your account and you go to the ATM and you click, I want to take out $200, the ATM will not, they will decline the transaction because you don't have more enough money in the account. So the account will actually, you can take it down to zero, but you can't take it negative with a debit card. It wouldn't let you withdraw money. It will decline the transaction. If you go to a store and it costs you $100 and you only have $50 in your account, it will decline the transaction because you don't have enough money in your account. It's different. The debit card is definitely different than a credit card, which we'll go later and talk about next time. Talk about what is credit card and what's the difference between debit card and credit card. You have the return deposit charge. Let's say you deposit the check and the check is a bad check. I mean that there's no deposit and there's no fund in the other person that gave you the check. There's a deposit charges, hard copy statement. Some financial institutions do charge for a statement fee. So you always want to make sure that you sign for e-statement. It also helps save trees and keep the carbon print foot much less. It's less paper. And ATM fees. Some institutions do provide ATM fees, so you always want to make sure that you check what the fees are. And lost card fees. Sometimes when you lose your card, you would want to make sure that they have to issue a card right away, or they have to send it to you. So there's going to be some fee that involved in it. So we learn a little bit about what a deposit account, what you draw, what loan, what interest, what ATM, what kind of the tools, the services that financial institution provide you to manage your money. And today with so many people commit identity fraud and trying to steal money from your bank. There's some tips I want to share to help you to prevent fraud. One, check your account activity regularly. So if you have an account and you open an account, you want to make sure that you have the ability to log online and check your account regularly to make sure there's no weird transactions happening in your account. No one stole the information and no one suddenly took it. Even if you see usually when the thieves start, the fraudsters start stealing from your account, they don't steal $100. They usually steal $2 to make sure that the account is good. And then they will they totally empty your account. So you want to make sure that in a transaction that you're not familiar with, you want to make sure that you flag it and you call your financial institution and say, I see a transaction at my account. I didn't do it. Can you help me? And of course, they will help you. Keep your PIN number and password secret. When you receive your PIN number for your ATM or when you create a password for your online banking, on your mobile banking, do not share your password with anyone. It's your password. Do not share it. Don't give it to anyone because once you have it, they can take all your money from your account. Use a strong password online banking. Create a strong password. Don't call it password 123. Make sure that you create a strong password for online banking so people cannot go into your account. Change your password. I would suggest every couple of months, change your password. Don't keep it the same one. Change your password so people cannot go into your checking account or any account. Do not give out account information over the phone. No one will call you and ask you from a financial institution, ask you for your account information, for your social security or any other information like this. No one ever will. So never give your information over your phone, and the financial institution will not call you and ask you for this information. Do not give account information to the mail. Don't send in your account information anyone because, again, the fraudsters are out there and they may send you information and say, we just got this information from you and can you send us a check, a blank check, your blank check or a check that you sign in, and because we want to check your account. Never send information to anyone. If you have any question, again, ask your parents or call your financial institution and they'll be able to help you. Do not click on links embedded in email, of course. If the a bad link because they can take over your computer. And when you log into your account, the bank will not send you, credit union will not send you any emails that ask you to, give you information, share your information online. If you get some information, you're not sure, what I will do is don't go into your email, but go into your bank account or your credit union account via your web browser and don't to the link to that embedded in the email. Antivirus protection software is always important. Do not use public computers for online banking. If you go to the library, please do not use your online banking, because what happened is some cookies left and you never know if you didn't log out of it and you just went out of the computer and someone else stayed there, or someone can stand behind you. So don't use public computers for online banking. Check secure connection always. Make sure you secure connection. Report your lost card immediately. If you lose your car, make sure that you report it immediately. And always have a program your credit union or bank information, a number into your phone, so you can call them and say, I lost my card, or you can go to the nearest branch and they will help you. But always, when you report that you lost your card, there's a chance that first of all, they will block it right away so people can do any transaction, but any money that you lost out of it, you might be able to get back. Beware of surrounding when you go take money from ATM. Make sure that you look around, there's no one behind you that you think that's suspicious, and also check out for skimmers. So what happened, a number of ATM, many times the fraudster do put devices on the ATM that actually are not part of the ATM. So need to make sure that you're familiar with, when you go and look at the ATM, you can always ask the teller or financial representative, can you show me an ATM and how your ATM look and so forth. So someone, and how do I work it? So when you go in, if you're not sure, ask someone to show you, and they can show you, and ask them, how do I know if there's skimmers or not attached to it? And they can tell you how to look if there's no any device that's attached to it that actually read your card, and you put your number and they read your information, and they can actually go into your account. So very short, what is a loan? And we're going to go over what is a loan next time. A loan is a way of the financial institution to extend credit to you and like give you a more loan for home, for car loan, for student loans, personal loans, credit card, business loan, and so forth, to help you to get to do bigger purchases that you cannot do because you maybe don't have the money right now. So you can enable you to get something much bigger, and you will have to pay back the fees, the interest back to the bank or the credit union fees. So we talk next week a little bit more about loans and what the importance of loan, how to use it, and how to build your credit, and what credit has to do with loans and so forth. A little bit about borrowing money. Thing to think about before you borrow money, and we could talk about a little bit more, is about credit worthiness. I mean, why is your credit important? This is kind of a really a peek a little bit into next month's session. Monthly payment. What is monthly payment? Do I have to pay it? How much do I pay, and so forth? What is interest on the loan? How much? How is calculated? Money is paid back. Do I have to pay it back? How do I pay it back? And I am going to pay this money. Think about, am I able to pay this money back that I want to borrow? So this is some of the things that we will talk about next month, and talk about a little bit how you build your credit and so forth. So just give you ideas of some of the things that we will talk about next month, and talk about what is repossession and foreclosure, and about how do you get your credit score, and so forth. So this is for today. Thank you again for listening, and I'm happy that to answer any questions that you have now. And again, my name is Doron Neumann, and if ever you have any questions, I will say you can always contact us, KeyPoint Credit Union, and we have a branch in Cupertino. The manager is Albert Lee, and if you have any questions, you're always more than welcome to go and ask him a question. But if anywhere you go, and if it's credit union or bank, you always want to make sure that you ask questions, because if you don't ask the questions, sometimes it leads to a point where you have misinformation about how to handle things, and it's really hard to manage your money when you don't know how to do it. So always ask question, reads the document. Okay. I don't know, Kelly, Rachel, if we do have any questions.
Yeah, thank you, Mr. Norman, for this presentation on all of the insightful information. And yeah, we're going to get started with our Q&A session right now. So if anyone has any questions, feel free to drop it into the Q&A section below and we'll get to them. Yeah, so we have a couple questions already. So getting started with the first one, what is a 401k and should teens worry about it?
Okay, great question. So 401k, it's a saving program. When you start working for employer, you receive, it's a retirement account. So what happened, part of your pay, you can put in this account. It's a type of retirement account that actually the money that you let's say you get paid $100, you can put money into this account, and this account, it's a pre-tax money that goes into the account. So before you get paid taxes on how much you made, you can actually allocate certain amount of money into the account. And some companies will match certain amount of money. If it's the first 5% or the first 3%, they'll match it into this account. So it's a savings account, investment account that the company usually has to. Individual cannot start it. It's a company sponsor account that you can, once you start working, and you can pay to it. Teens should not worry about it because you don't really have. I mean, when you start working in a company, I mean, really, you still go to school. So if you have a summer job, usually the company will not open for you a 401k. It's usually a full-time or part-time, but it's not like a summer job and so forth. They won't open. It's some companies will start it only when you're 6 months with the company. It depends on the company's policy, but don't worry about it. But when you do get a job and you graduate from college, if you go to college, or you don't go to college but you graduate and you start a full-time job or part-time job, always ask the company, do you have a 401k? It's a great idea, because what happened, you put money into it, and as soon as you start, more money you have in retirement. But nice thing about it, that the company will match certain percentage of it, and you can accumulate a lot of money and be very affluent when you retire. If you start early investing into it and consistently investing into it to your job, you can retire well.
Okay, thank you. Our next question is, if a teen wants to invest in stocks, can they? And how do you start investing early?
Okay, so you can definitely invest in stock. The thing is that depends on the company. Most of it, you cannot open an investment account until you're 18 years old. So some companies you can open, some teens. I mean, I have two teenagers, so I'm familiar with some of the things that happen with some different online companies. But what happened, when you're a teen, you can always invest. The different programs. Usually, what happen in financial institution, you have a financial advisor. You can go and talk with them. It's usually your investment account until you're 18 years old is under your parents' account. So you cannot really. Most financial institution will not let you invest until you're 18 years old. When you come 18, then you can invest. Always start early, of course. It's a great way to know. I will encourage you to read all about it, to understand it. Some people do mock investing, but if you have money, you can definitely, there are programs for teens, but you're actually not the person that can invest. You can give your parents, they can invest for you, but you cannot actually do the transaction. You can do transactions, so forth. You can recommend, but you cannot do the investment because of your age and the legality of what account you can open and so forth. But definitely start investing as soon as you can. Yeah.
Okay, thank you. Our next question is, what role does market value play in teen finances?
Okay. Well, market value, as far as I need a little bit of information, but I assume that you talk about stock market value. So definitely, I mean, you want to be familiar if you want to learn about investment and so forth. You want to learn about market, market value, what the valuations are for companies, what is the market and so forth. I will say start early. There's so many programs out there. Talk with your parents, learn how to invest, learn how to, and then talk with a financial. You want to talk every time you have some investment. You want to make sure you talk with the financial advisor, the license to talk about any investment and so forth. So you have to be a certified financial advisor to talk about it. When you get 18, you can open your account, your brokerage account online. But I would just, again, everyone has their certain risk tolerance and so forth. But I would recommend talk with the financial advisor and someone that really understand and help you to invest on the long term. To make it, the investment is a long term thing. Okay.
Okay,
And next
great.
question.
Thank you. Yeah, our next question is, how does COVID affect banking situations?
Okay, so most of the things that happen today with banking, you can do online. So really, a lot of the transactions that you can do to your mobile banking, your web bank, internet, online banking. You can take money anywhere. So if the branches are closed, you can still have access to your money, and you can still pay. You can still do shopping online. You can still move money from pay your friends and so forth. Most of the things today are done online, and most of the things that you need to do are online. So it did affect banking, in fact that some places had to close branches for a short period of time, but branches stay open for most of the time, and you can go into the branch and so forth. But most of the thing you can do to ATM and to online banking and mobile banking. Yeah.
Okay. And our final question for now, can teens invest through a custodial account?
Well, you can give your money. I mean, a custodial account it's in a way you own the account, but it's run by your parents. I mean, the main person on your account, legal person, the account's illegal. It's your parents or legal guardian that own the account. You own the account, mean that the account turned to you by the time you get to 18. So even savings account or checking account, it's under your parents, because legally you can sign documents. So you have to have an adult guaranteed for you. If you have money and the account provides some investment opportunities, you can definitely talk with your parents, and they can help you, or the legal guardian, and they can help you to invest to the account. But it's any account like this, an adult has to be a signer for this account for legal reasons until you're 18 years old. So you can always talk with the parents, and you can talk, parents or financial advisor, and get the advice what to do. But always the account is under the legal guardian or the parents of the person, of the teen. Yeah, those questions are great questions. And again, thank you so much. And if you have more questions, please let us know. I'll be here next month, and we do the next session. But those are great questions. One thing I encourage you is to read a lot, to learn a lot. There's so much information out there. My always recommendation is read 10 to 15 minutes a day about personal finance. And you see that within a year, you accumulate so much information and so much knowledge. The better you know, the more successful you will be, and better you will have, your financial health will be. So again, thank you very much. I don't know if any other questions.
No, I think that was our last one.
Okay. Well, thank you very much, and I really appreciate you taking the time on the weekend and attending this session.
Yep. So this concludes the first session of our 3-part teen financial literacy workshop series. Thank you so much for joining us this afternoon, and we hope you found it informational. We'd also like to thank our wonderful panelist for his presentation and for helping out students during these unprecedented times. We hope to see you for our next session, and make sure to fill out the survey link in the chat before you leave. Thank you.